All right. Hello and welcome. Today we are diving into a really fascinating and, honestly, a kind of hidden corner of global finance. We're talking about a world where Wall Street is literally betting on hurricanes, earthquakes, even pandemics.
So it all kicks off with this simple but kind of terrifying question. Look, we all rely on insurance, right? It's there to protect us from the worst. But what happens when a disaster is just so massive, so destructive, that it threatens to completely break the very companies that are supposed to be our safety net?
Well, to really get the answer, we got to rewind the clock. We have to go back to one single storm that basically blew the lid off a huge vulnerability in the entire insurance world.
So in 1992, Hurricane Andrew comes roaring ashore. And look, this wasn't just another powerful storm. No, this was a financial event unlike anything they'd ever seen. The sheer scale of the destruction, it caught the entire insurance industry completely, totally flat-footed.
$25 billion. Just let that sink in. That was the final bill. I mean, a number that big, it just completely overwhelmed the system. You had insurance companies literally going bankrupt. They just couldn't pay the claims. And that's when the industry had this collective uh-oh moment. They realized they had a massive, massive problem. They simply didn't have enough cash on hand for a true mega disaster.
So what do you do? Well, the solution that popped up was pretty unexpected. Faced with this massive crisis, the insurance industry turned to a partner you might not expect, but one with incredibly deep pockets. Yep, Wall Street. And the logic here, it was actually pretty simple. Think about it. The traditional market for backing up insurance companies, what's called reinsurance, it was like a puddle. But the global capital markets, that was a massive ocean of money. The thinking was, hey, if we can just figure out a way to tap into that ocean, we can find the money to cover almost any disaster you can possibly imagine.
And you can see on this timeline just how fast this whole idea came together. So first, you've got Hurricane Andrew in '92 exposing the problem. Then, a few years later, you've got these big-time deals from Warren Buffett's Berkshire Hathaway. And that proves something huge, that major investors were actually willing to take on this kind of risk, for the right price. And that led directly to the first modern catastrophe bond in '97. But the real game changer? Hurricane Katrina in 2005. That just poured gasoline on the fire and made this market what it is today.
Okay, so the big question is, how on earth do you actually sell the risk of a hurricane to, say, a pension fund? Well, it all comes down to some seriously clever financial engineering.
And at the heart of it all is this thing called an Insurance Linked Security, or ILS for short. Really, all it is a way to package up the financial risk of a specific event, like, let's say, a major California earthquake, and then sell it to investors in the form of a bond.
All right, let's walk through how the money and the risk actually move around. It's pretty cool. So first, the insurance company, they're called the sponsor, pays premiums into this special separate company that's set up just for this deal. Then, that company issues bonds to investors, who put up their cash, which goes into a secure account as collateral. Now comes the waiting game. For a few years, as long as no disaster strikes, those investors are collecting some pretty nice interest payments. And hey, if the bond matures and nothing bad happened, they get all their money back plus the interest they earned. But, and this is the big but, if that specific disaster does happen, their investment money is used to pay the insurance claims, and yeah, they can lose it all.
And that is the really powerful flip at the heart of this whole thing. See, with your normal insurance, you pay a premium to get rid of your risk. With these securities, investors get paid a premium in the form of interest to take on an insurer's risk. It's why some people call it reverse insurance, which is a perfect way to think about it. Now, you might be asking, why would investors do this? Well, here's the magic trick. The risk of a hurricane hitting Florida has absolutely zero to do with whether the stock market is up or down. It's what they call an uncorrelated risk. And for a big investor, that is like the holy grail of building a balanced portfolio.
And we're not just talking about one single product here. Oh no, the ILS market has really evolved. It's now like a whole menu of different ways for investors to bet on disaster. Or maybe a better way to put it is provide capital against disaster. So on that menu, you've got the most famous item, catastrophe bonds, or cat bonds. Those are the ones you can trade publicly. Then you've got these more private deals, like collateralized reinsurance, and these things called sidecars, which are pretty cool. Investors basically take a direct slice of an insurer's business for a specific risk. But it gets even wilder. It goes beyond natural disasters to what's called life ILS. And these can cover things like pandemics, or even the financial risk of people living longer than anyone expected.
So you can see, this is not some tiny little experimental niche anymore. Not at all. This whole idea, which was born out of that Hurricane Andrew crisis, has just exploded into a truly massive global market.
How massive? $107 billion. That's how much capital investors have put on the line right now to backstop the world's biggest risks. I mean, that is a staggering figure, and what's crazier is that it has nearly doubled in just the last 10 years.
And if we break that number down, you can see something pretty interesting. While the cat bonds get all the headlines, it's actually the private deals, that collateralized reinsurance, that make up the biggest slice of the pie. It just goes to show you, it's a really deep and diverse market.
And the players involved? I mean, it's a real who's who of global finance and government. On one side, you have the ones selling the risk, insurers, big reinsurance companies, and even governments like FEMA and the World Bank. On the other side, buying that risk, you have the world's biggest pension funds, hedge funds, and asset managers. And right in the middle, you've got the investment banks and the big brokers, the deal makers who make the whole thing happen.
Okay, so let's take a step back. What does this all actually mean? Why should any of us care about this super complex financial machine? What's the real big picture takeaway here? Well, here's why it matters. What started out as this alternative source of money is now absolutely fundamental to how things work. This market, it provides something like 15 to 20%, up to a fifth of all the financial backing that allows people to rebuild their homes, their businesses, after the worst disasters imaginable. It's not alternative anymore. It's a core pillar of the global insurance system.
At the end of the day, that's what this market really does. It's a bridge. It connects society's biggest, scariest risks to the single deepest pool of money on the planet. Its job is to spread the financial pain of a disaster so wide, so thin, that no one company, no one entity has to take the full hit.
And that leaves us with one last, kind of provocative thought to chew on. You know, in a world where we're facing more and more risk from climate change and other threats, is this unique model, where investors literally get paid to bet that a disaster won't happen, is it a critical tool that makes us all more resilient, or is it a massive financial gamble that just hasn't faced its ultimate test yet?